All right. Okay. So today we are talking with Daniel Truque. He's the alternative asset business development lead at Symbiont, a company seeking to build the next generation of financial markets infrastructure through the use of blockchain technology. So I guess like kind of before we get into everything, just like how did you get involved at Symbiont and what really drew you to this company and blockchain technology?
Mm-hmm. So my path leading to Symbiont was actually not a straight one. Um, I I knew I wanted to get into blockchain. I took several companies, and in the end, kind of like the only viable option that I saw was Symbiont. So I'll go back a bit more. So in my background, actually, I studied electrical engineering, got a master's at MIT on that, but ended up never working on that. I got poached out of the PhD program by McKinsey, and I ended up working in risk management. It was during the financial crisis, so a lot of U.S. financial institutions were blowing up. So there was a lot of demand from the risk management practice. That exposed me to the banking world, which I was fascinated by. I don't know if it was because I inherently liked it or it was just not engineering stuff, so it was just interesting. So I ended up moving to banking. Being originally from Costa Rica, I wanted to do something with a Latin American focus. And I also wanted to go into banking, given all the banks I had worked with while at McKinsey. What happened there eventually was that JP Morgan was essentially firing everybody, and HSBC was hiring people. So the choice was quite simple. Those were the two leaders in the region at the time, and one was shedding employees while the other one was hiring. So I worked for HSBC for 3 years, mostly mergers and acquisitions, and then leverage finance. Leverage finance is just a fancy term for raising debt for M&A deals. Um, so whether it's bonds or syndicated loans, etc. Eventually, as many of my peers, ended up moving to a hedge fund. So I worked at Ray Dalio's fund, Bridgewater, which was a very particular culture, super interesting place. Loved it while I was there. I left to work on a startup called Market Realist that I had helped create while I was still back at HSBC. And they had raised capital so they could hire me full time. Market Realist was focused on writing financial equity research and making it available to the crowds via their website. So it was funded via online advertising. Eventually, I decided to go back to quantitative finance, working at AQR. AQR, just like Bridgewater, is another very large quantitative macro hedge fund. Also, like another like 250 odd $billion under management. Much more academic environment than Bridgewater. Bridgewater, because of the principles, it was also things were on a need to know basis. It was very open in terms of feedback and exploring your psyche and what drives you, but not in terms of about talking openly about the strategies. AQR was the opposite. It was great. You could nerd out and go to any team and ask how like the strategies work. So I loved it there. While I was there, one of my good friends that I had hired at the prior startup had an idea that we thought it would be a perfect candidate for an ICO. We had been looking at what was a crowdsourced problem-solving engine that essentially would harness the power of the crowd to address these large-scale social problems. We had been looking at several essentially moderated models and just like incentive models. And then suddenly along comes the ICOs. And I was like, well, this is easy. Put a token on it and the thing just solves itself. We got an interview with Joe Lubin, one of the co-founders of Ethereum, the founder of Consensus, the largest consultant firm behind Ethereum, to discuss this. And he actually loved it. And he said, yeah, we could advise you. We could bring you under the Ethereum umbrella and incubate you. They were like, he was pretty open to the idea. He liked it. And we had come referred from Mark Smith, who was the founder of Symbiont. I do remember Joe saying, why would you be coming to me if you have Mark's technology? And at that time, I was like, what does he mean? Like, what's so important about Symbiont? Like, I mean, you're Joe Lubin and this is Ethereum. Like, this is what we want. Like, forget about Symbiont. Long story short, I mean, being a foreigner here on a work visa, you're allowed to work only in the industry that says on your work visa. If I were to do an ICO, given that things didn't seem to be legal, if I get a slap on the wrist by the SEC, I have to leave. So not worth the risk. I'm not gonna deport myself in the process. So screw it. Let's table the idea for now. I'm gonna stay at AQR. Because I already had that blockchain bug, then I started, at the same time, another friend of mine at AQR was starting an internal blockchain group. And when I told him about my idea of starting a group, he was like, "Oh, I'm actually already starting that." So we joined the idea, and we ran that. And at some point, we're having like 75 people attending to these launches, which was fantastic. We're looking at blockchain from 3 areas: tax and regulatory implications. Number 2, blockchain as a technology, so just discussing white papers and understanding the different consensus mechanisms and incentives, etc. And number three, being a quant fund, we wanted to see what is the alpha opportunity on the different cryptocurrencies. Eventually, my friend, his name's Anton Katz, is actually the founder of Talos, which is creating a trading platform for institutional players within the crypto space. He left to create that platform. And at that point, I was feeling, okay, I'm missing the train. If I really want to do blockchain, I just need to go. So I left and I spent the 6 months looking and talking and joining every single webinar, conference, meetup in New York on blockchain. That's the best advice for anybody who wants to get involved in blockchain. Go everywhere. Quick flashback back to when I was being a consultant. I was crossing the street in Chicago, going to the bank where I was working at the time. That was a client, and the strap of my laptop fell, and I just like got down to like pick up. I mean, I was crossing the street, and then I hear screeching tires, and I turn around, and I see a bumper like next to my face. I was like, well, that was dumb. It's fine to get the laptop run over. I don't want to get run over. But luckily, nothing happened. But then when I turn around, I look at the bumper sticker, and it said, the world is run by those who show up. So you want to get into blockchain? Show up. Go to every single event. Talk to everybody. Have something to offer. Have something to learn. Have good questions. Show up to everything. There's so many events right now, especially online, given the pandemic. There's no excuse not to show up. Go to everything. Learn as much as you can. So anyway, so that's what I did for 6 months. At the same time, I wanted to create a cryptocurrency fund. So I actually went as far as to create the whole legal entity and everything in Cayman and created a project called Satoshi Capital. Last minute, we pulled the plug because the manager that we're going to launch with, he didn't pass our KYC. Essentially, we got tipped that he had done some pump and dump in the past. And while that is not illegal in crypto, it's unethical. And we knew that crypto would eventually get regulated. And I wouldn't want to be in a situation in the future where this manager does something dumb and screws up the client's funds. And I need to say like, yeah, I knew he had done some dodgy stuff. So we pulled the plug, and that actually then solidified my need to actually, okay, I got to go get a job. So the Satoshi Capital project actually lived on its own afterwards because my partner, Josiah, who also has a fantastic background in crypto, kept it going for consulting projects. So he consults for mining, energy sources that want to implement mining, or advising banks on blockchain-based payment rails, whether it's CBDC, stablecoins, etc. And also, I've been helping also with incubating some quantitative managers, regardless. But long story short, going back to what the connection was, after spending 6 months on fully in to my neck in the blockchain industry, I was like, this is all smoke and mirrors. Once you ask enough questions, there's not enough level of detail. Everybody has big plans, but nobody has something. Like, I'm going to have to go back to finance. And at the time, I was actually interviewing with JP Morgan, and I was like, hey, that's I guess I'm going back to banking. I spoke with my friend Jeremy, the one that I had attempted to do this crowdsourced problem-solving engine as a token-based model. And and I asked him, at the time he had just started working with Symbiont, and I told him, get me an interview with Mark. I want to talk to see what Symbiont has. And I spoke with him, and I was super impressed. I was like, wow, this is the only blockchain company that has legit stuff going on. And Mark told me how Symbiont had just helped change the law in Delaware to enable companies to incorporate directly on a distributed ledger. He told me how they were talking with NASDAQ, who was going to come in as an investor in their latest round. He mentioned all the projects they had going on with Vanguard, et cetera, et cetera. So it seemed like a fantastic opportunity. And best of all, they had an opening for somebody to manage the NASDAQ relationship. So for me, it was a no-brainer. So it was the one company that I thought was viable, that had large, meaningful clients doing relevant work in the sector for adoption. And that's essentially how I ended up at Symbiont. So through an old connection, and by realizing that it was the one company that I thought they have, they know what's going on.
Yeah, that's what I've noticed. It's like, I feel like this industry has like a lot of just like future potential, but sometimes it's there's a lot of like fishy stuff going on as well. So you have to find like that area where they're really doing good work. So.
A lot of it, and this is not unlike any other startup industries. It's a fake it till we make it environment. And Symbiont has the advantage that it was founded back in 2013. So when I joined 3 years ago, it was already like a 3-4-year-old company. It was not like the company that had just launched in 2017 or something, still trying to even like hire a team. So it's a different thing. Like it's not If you talk to a company that is like under 3 years old, you're in the fake it till you make it stage. You still have a plan. You're trying to execute against it. It's very unlikely that you have everything sorted out. And even if you have like a very solid roadmap on what you want to do, then maybe you don't have the funding or you don't have the team. So it's normal that early companies don't know what they're doing. It just happens to be in the case of Symbiont, we're pretty much like among the earliest ones in the ecosystem.
Yeah. So it says, so your alternative assets and business development leads. So do you know like exactly like what that role entails and like what are alternative assets?
Yeah, so alternative assets, what I love about it is that it's essentially the exploratory business area within the company. Alternative assets, it's the simplest definition is anything that is not traditional assets. What is traditional assets? We're talking about public securities, bonds, currencies, commodities, equities. That's traditional stuff. So alternative assets is stuff that is not that. So the first thing, which is closest to that, is actually private shares of companies. So, shares of private companies. Why? Because if you're not listed, then it's not like public equities. It doesn't trade on liquid exchanges. It actually trades over the counter. And that's actually something where blockchain adds a lot of value because it can automate a lot of those transfers that otherwise require, a lot of time and an army of lawyers to get it done. So there's a lot of frictions. So alternative assets includes that. Like, so you have shares of private companies that now you're able to like hopefully trade with less frictions, even though blockchain, to be clear, there's no guarantee that generates liquidity. It's just, it greases the wheel so that eventually if there's more liquidity, things can happen faster. So there's that. Then you have other stuff like fractionalized real estate, simply having a piece of property and fractionalizing it. There's also simply funds of real estate. Real estate, it's an old asset class, but some people still consider it an alternative asset. In the case of tokenized real estate funds, the cool thing about it is that you can actually be talking about tokenizing a single building or tokenizing a portfolio of real estate assets. You also have collectibles. Companies like Rally Road, for example, which I love, they what they do is you can actually buy a fraction of a collectible item, whether it's like some old pair of sneakers from Muhammad Ali or like a piece of some 70s muscle car or even a first edition Harry Potter book. So they do that. And it's pretty cool because it's essentially similar craze to what you see in the NFT world, but with real stuff that actually exists in the real world and it's there. It's not some art that somebody just drew digitally and now somehow has value. This is actually like real stuff. So look at a Rally Road, one of my favorite companies. The value in blockchain is that once they reach large volumes, using blockchain actually helps manage all the complexity and the operations behind it. At the initial stages, they don't need it. Eventually, it really helps to enable the blockchain aspect of it.
So how does like so if you have like fractional ownership of like an object in the real world, so let's say like this cup, like how would it work if like you each have like a fractional ownership of the cup?
Well, like the first thing that you need in that case, when you're talking about like a real world asset, you need somebody that is a custodian. That is not undifferent the way public markets works nowadays. When you buy nowadays a share of Tesla, that share of Tesla is actually held at the DTCC, which is the Central Securities Depository for all securities in the US. Then the DTCC has accounts for brokers, like JP Morgan, Schwab, Vanguard, etc., that then hold that on behalf of the ultimate beneficiary investors. So it's an indirect nominee system in which the shares that you own, you don't own them, and your broker doesn't own them. Everything is owned by the DTCC, and then they bestow upon you an ownership right. They did that because back in the 70s, when the stock market started heating up, they literally hit something called the paperwork crisis, and they actually ended up closing the markets on Wednesdays so they could do all the accounting for all the papers. A lot of terms that you hear today, like modern finance, like book runners, for example, and all that stuff. It was because literally you had kids that, well, not kids, I mean like the young people that would go around and deliver the certificates. So if JP Morgan sold something to, I don't know, Morgan Stanley, literally a messenger would be sent with a bag with the bonds or something that now they go and they gotta move. So they realized it doesn't make sense to move the securities. We need to immobilize them. So the DTCC was created as a temporary solution to immobilize securities in one spot, and then simply everybody has accounts there. And then so if I sell securities to you, we both have accounts here at the DTCC. The DTCC simply says, these are no longer from Dan, these are now from Jade. That's it. So you don't need to like have people send around and move stuff. That was a temporary solution while the market was getting digitized. Here we are 50 years later, the markets are still based on this like dinosaur temporary duct tape model of immobilizing securities that are owned by somebody else. By law, you don't own the securities that you own. A lot of anarchists say that, oh, well, then that means the government owns all your stuff. They're not going to take your stuff. That's a little too much. Yes, you don't know it directly, but there's a whole legal system that says, okay, like they're holding it on your behalf. That's okay. But that brings a lot of inefficiencies to it. So with blockchain, you can actually then essentially have direct custody of your assets. And then if a custodian by law needs to prove a control of those assets, all you have to do is have a multi-sig contract that holds that asset so that you, even if it's yours, cannot move it unless the custodian signs off on it. And then to be able to do that, then the custodian needs to be able to prove exclusive control of the keys, which means support for HSM, hardware security modules or something like that. That is a key distinction of Symbiont versus other blockchains, because since we support HSMs, then you can enable that control location issue of it, and you can actually bring back direct ownership while still enabling custody of assets, which means you are actually you're abiding by the existing regulation, existing law. Most of our securities laws date back to the 1930s. They still apply, and they have gone through a lot of technological innovations through the decades. There's a few things here and there that need to be tweaked, but we don't need a whole new law to regulate ICOs, NFTs, and all these things. If you issue an NFT that pays music royalties, that's a security, period. It doesn't matter if it's an NFT, a token, or a stock share like airdrop, as they existed back in the dot-com boom. Back then, people would also, like nowadays we have the airdrops where people get tokens, and they do that so that people then start trading them. And, oh, this is worth something, so I'll get it. They did the exact same thing back in the dot-com boom, where people would get like, oh, here's some shares, and then people are excited they have them, and they start trading them. So like you drop some shares, so it actually creates a market value for the other shares that you didn't drop. So that is also a securities offering. Like a lot of people say like, well, airdrops get around it. No, they don't. It's the same scheme, different technology. The problem is that you have in many cases either young people that don't know the past. And I mean, I was in high school when the dot-com boom was around. So it's not like I lived through it. No, I'm not that old. But you need to realize that there's a history that happened before, and it's worth looking back, and you have to look back several decades to understand how these technological changes affect and are modified by the regulation, not the other way around. The regulation does not get modified to accommodate the new technology. You gotta look at it in the essence of the law, not exactly as something that is very prescribed. It's a different approach. You don't, like a lot of people say that you need to modify the law. Yes, there's things you can tweak, but you don't need a whole new law to regulate what ICOs are. The securities laws cover a lot of that. And at the core, the whole point is to defend, investors from scams, and whether people like it or not. And yes, it may be stifling innovation. A lot of people lost money during the ICOs. I invested in ICOs that went nowhere. I did find a token in my wallet the other day that apparently now is worth like 5 or 10 grand. So that was a nice surprise. But like in general, I lost a lot more money than that in tokens that just went down the toilet. They were like scams.
So do you have any advice for somebody like looking to get into like the ICO market, get in on those coins that are kind of risky but could have like potential gains in the future? Do you have any advice for somebody like trying to get into that and avoid like kind of like the scammy type scenarios?
The best advice is don't. You're gambling. That's it. I mean, you're gambling. If you insist, though, if you're gonna do it, again, it's not financial advice, but if you insist on getting that market because like you have that gold bug in you and you have some money that you're willing to like throw down the drain, diversification that applies in any market. You gotta buy a bunch of stuff, but that won't defend you from investing in a bunch of trash anyways. So you need to know the projects. Look at their GitHub repositories. GitHub is where public projects actually keep all their development activities. So you got to look like how many commits, how much activity is going on there. Is it steady? Is there something here? Or did these guys just release a white paper and nothing else is happening? Who are the advisors that are named in the white paper? Look them up on LinkedIn. Do they list the project? Or did somebody just randomly put their name? Or they said, yeah, I put my name there, but I get some tokens, but they're not actually doing anything. So like at least having it listed on their LinkedIn shows that, you know, they're not hiding it. So you gotta like do your diligence. The best option really is you could also look at the different VCs in the space and see what they invested in. So get familiar with which are the large venture capital firms, see what they invest in, and then buy the same stuff. Why? Because they have deep pockets. So if a project is gonna go belly up, they're probably gonna like throw more money at it to defend their investment. Not a good practice, but they likely will. But at the best, at least they're gonna use their marketing muscle to push these projects. And also, I mean, they have analysts that know and breathe and understand this very deeply. So if you're new to the game, follow the experts. See who are the VCs behind this, but also know very clearly that just like following what Warren Buffett does, it will not guarantee you profits. Why? Because Warren Buffett gets deals, you know, in traditional markets that he gets because he's Warren Buffett. He's not buying at retail price. He's got special stuff. Just like the VCs get a lot of other stuff. So even if you follow what the VCs do, you may be too late. But at the very least, you're likely not investing in a project that it's going to be empty.
Okay.
But the best advice is don't. Like, to be clear, like unless you literally have money that you just want to throw away. Right. There's a lot of other ways to make money, and hodling on stuff is not great. And the other approach, of course, is daily scalping, all that, but it takes a lot of skill. The best advice there is understand how market makers transact. Once you understand the psychology of market makers, you have an edge of the over 90% of the market. That's why so many people lose money in day trading, because they don't understand they're actually trading against the market makers that literally do this for a living.
Yeah.
What do you feel about the future of cryptocurrencies?
Oof, that's a loaded question.
Yeah.
Let's break it down in two areas. On one side, blockchain, and on one side, cryptocurrencies. On the blockchain side, the technology is more than just cryptocurrencies. Cryptocurrencies is one very narrow application of blockchains. The simple transfer of tokens between two parties. That's it. Blockchain technology in itself has much broader sense, like array of use cases. So if you look at stuff in permission blockchains, there's some stuff you can do there that would never even be possible in a public blockchain. There's trade-offs on both sides, but that's one of the key things. Cryptocurrencies are unstoppable in many cases, but a lot of the smaller coins, they can easily just disappear and erode into oblivion. You can actually, if you tell me what do I think about Ethereum and Bitcoin, you know, the main coins, yeah, they're probably going to be around. They're large enough. They're likely not going to go to zero, or if they do, they won't be the first ones to do so. You'll have enough signs to get out before it. But you cannot say the same thing for the smaller ones. But trends like NFTs or DeFi, stuff like that, even if right now the regulators are quite against a lot of these things, whether because they're securities or because they're doing bank lending activities without a banking license, or they're, in the case of stablecoins, they're essentially providing a stablecoin without being fully backed one-to-one. So it's not a one-to-one backing, but it's a fractional reserve system. All these things, even if they're illegal, they may actually be prevented to be done by institutions, but the people, the crowd, can do that. And the regulators cannot come after everybody. They will come after the large institutions that would facilitate that, which means you're not going to get institutional adoption, which means you're not going to have like additional like innovation in that sense. But that won't stop it from spreading like wildfire on through retail investors all over the world. When DeFi first came out, I was like, that's illegal, it's never going to work, but you cannot stop it. But because it's clunky, it's hard to use, nobody's providing a user interface, nobody's providing support, and nobody's providing insurance. The moment somebody provides either a user interface, technical support, or insurance, the regulators are going to drop on them. And that's why this is never going to grow. And then I realized it will grow a lot in the retail crowd. Again, it's very hard for this to gain institutional adoption if it's not a regulated activity.
Do you think it's possible that like in the future, like one day, like Bitcoin could maybe like replace the USD as a reserve currency, or do you think it's like wishful thinking?
It could and it couldn't. I mean, it depends. One of the advantages of Bitcoin payments is the reduction of frictions. if let's say the Swift network happens to come up with a blockchain-based system that uses a stablecoin, that could actually then allow people to send money very seamlessly back and forth. The advantage of the US dollar is that it's stable. You don't need a stablecoin if you're actually moving dollars back and forth. If the Fed decides to issue dollars directly on their own blockchain or on some chain or something, you have the same operational efficiencies. People are using blockchain for transfers because it's easier. Corporations are not going to send Bitcoin because of the volatility, and right now there's not enough volume to have hedging products that would be cheap to avoid all that volatility. So if you actually come up with a blockchain solution that actually uses dollars, at least in developed markets, that would be extremely attractive. So
this might be kind of a stupid question, but how would someone like go about creating a stable coin? Because
there's clear regulation about it. You cannot simply like go and say like, hey, I'm holding this cash here and then here's some coins I created. That would be illegal. You need to create a trust company, and there's got to be you essentially are a money transmitter because a stable coin, you're transmitting money. So there's a you become a money services business, I think is the term. And there's a lot of stuff you got to do. There's got to be the trust with segregated funds that cannot be touched. There's got to be an audit to make sure that the funds match what you're minting. There's got to be KYC processes. You got to abide by anti-money laundering standards. Got to make sure that money doesn't violate any of the OFAC standards. OFAC is the agency of the U.S. that deals with all those transfers of money that may involve money laundering and other things. So there's a lot of regulations you have to do. Right now, doing a stablecoin on its own is not profitable. Why? Because interest rates are nearly at zero. That's why, for example, there's not a euro stablecoin, because in Europe right now interest rates are negative. So you wouldn't be able to make money. A lot of the stablecoin companies nowadays, they're actually making money not through the mere issuance of accumulating assets and paying interest. They're actually doing that via charging a fee for API access to their systems. Or another thing that they do is they raise capital through bonds. With those bonds, they get that capital and then they issue coins. And then those coins that they just minted, they lend them out to other parties that use them for hedge fund operations. That, of course, they're borrowing them at a much higher interest rate, and essentially they make a spread. Because essentially the interest rates are so low that just accumulating assets and earning an interest rate on it is not good enough. So several things are going on. Some of these companies are charging access for their APIs, so more like just payment rails, providing, being able to pay with a credit card, or like some more like just payment liquidation. So it's one. They also do what I mentioned of like issuing bonds to raise cash to then lend out. So it's just like a lending model. And then in the case of the, call it less honest stable coins, like Ether, they essentially they shift their reserves from just being pure cash, which nobody even believes Ether ever had $1 to $1 against their reserves, but they start investing in other riskier instruments. So for example, like corporate bonds and stuff like that. So at that point, you can't really say that they're back 1-to-1 because bonds are riskier. Like that bond can gain in value and it can also lower in value. In a bull market, it can be great. In a bear market, you can actually end up with limited reserves, diminished reserves.
What's your opinion on like the whole like Tether controversy that's going on right
now? The Tether what?
Like the controversy with Tether.
Well, it's exactly that. I mean, like Tether is they are saying that the reserves are not even 1-to-1. What they have is riskier assets. So Tether, unlike the other legit, or by legit I mean regulated stablecoin companies like Paxos, Circle, or Gemini, they are not regulated and they don't have these other businesses, so they just make money out of the reserves. It's no secret that in the end of 2016 run up of Bitcoin, there was a very huge increase in minting of Tether, and it was suspected that Bitfinex was actually using that to buy Bitcoin and essentially pump the price up. But all those tethers were not really backed by actual tethers. Bitfinex was the only exchange at the time that was able to offer tethers to the world. So there was a lot of shenanigans there. I don't know if that was ever cleared up, but there was a lot of suspicion that a lot of Tether got printed that didn't really exist, and that led to the run up in Bitcoin prices. But then, you know, craftily like collapsed afterwards.
Scary. Would you say that there's any like stable coin that you would feel comfortable putting your money into, or do you think that's kind of just like in general risky to put your money into these assets?
Well, why would you put money into a stable coin? It's not an income generating asset. If you want to park cash, if you literally just need a stable coin, then just you live in the US, put in a bank account. That's not an issue. That's an issue only if you happen to be unbanked and not eligible for banking. Let's say that, I don't know, the bank closed your account because they knew you were doing crypto activity, and now banks are closing accounts for that. Or if you happen to live in a country where you don't trust the banks because at any time the government can seize the accounts. But in the US, there's no reason to hold a stable coin. Well, there's one potential reason, which is you could mint a stable coin and then lend it out in a DeFi protocol and earn the spread. And that interest rate that you're earning is much higher than what the bank would give you. But it's also much higher because of the risk. We've known there's been a lot of sad occurrences in the DeFi market, to put it nicely. So yes, you're getting a higher interest rate, but don't put all your savings in the same contract. Spread it across a bunch of DeFi exchanges and know what you're doing. But it's, I mean, honestly, if you're doing all of that just to earn like a 6% interest rate, you're pinching pennies in front of a freight train. Not worth it.
So I guess like, so what do you feel like are the technical skills that are required to learn blockchain, like programming languages, stuff like that? Like what does somebody have to know to really enter like the blockchain world from the technical perspective?
Oh, the beauty of blockchain world is that it's not a single skill that you need. Blockchain is simply a technology. So it's one more tool that can apply to a lot of industries. In any industry, you're gonna need some guys that are more into tech and some other guys that maybe are better for the marketing side or business development or just account management. And you need product developers, you need actual software developers. So it really depends what your skill set is. I would say like it's not like suddenly, you know, okay, I need to go back to coding academy so I can learn how to code. But I mean, in your guys' cases, since you're still in school, yeah, definitely like knowing how to code, it's definitely a skill that is never going to backfire if you get it. But if somebody's more like, well, I want to get into blockchain, but I don't know how to code, does that mean I cannot participate? No, it's a lot of opportunities. And again, the best thing is go to every single event, meet everybody. The power of your network is going to be very important. If you're very well connected, you can actually then help in roles where you're doing business development. You can also be more of a, you know, like a technological evangelist where like explaining to people like different technologies, how they work, or like selling the specific product. So you don't need any specific skill. But of course, having a more technical background will help you understand the technology behind and avoid the hype-driven ignorance that a lot of people in the sector seem to have. That when you suddenly ask, well, is that smart? Does that blockchain have a smart contract set? They don't even know how to answer that. Or like, what is that consensus mechanism? And they look at you with a blank stare. Those are very basic things that I think everybody should know, regardless of which area of the company they're in. But it's not necessary. It's kind of call it like good hygiene, good career hygiene to be able to get to that threshold level of knowledge, especially in such a new industry. That's also a good way of recognizing whether the technology that you're selling is going somewhere or not. So you can decide to make your move. That's why I ended up at Symbiont, because I had looked at a lot of other places and I was like, nobody has anything real. Like, what's going on? It's like I thought I was like taking crazy pills. And then suddenly like this company comes around and they have all these big clients and they actually have like a proper roadmap and a real enormous development team, and they're doing stuff. So that is actually like super important.
And would you like, do you think like learning Solidity and learning how to program smart contracts is worth it, or getting into that now in our college careers?
So two things there. If you're going to be more on the development side, yes. If you think you're going to end up more like on the business side or sales or stuff like that, then it's a nice to know, but I wouldn't like completely go out of your way like if you don't have the time or something. Of course, I mean, you're in school, you have a lot of classes, homework and stuff. You also are going to have a lot of free time. So sure, definitely put the time in now that you can, because you have a lot of free time now that you're in school. Because afterwards, just time suddenly like disappears in front of your eyes. But the main thing is, if you have the time, sure. There are two main technologies out there, two big branches in blockchain: permission and public. The way of knowing each, I would say, like, learn the most popular one. So yes, you could learn how to do Solidity just to understand how these contracts work and understanding how the blockchain works. So if you're like code inclined, definitely go and learn Solidity. It's not the best language, but it's the most popular one, and it's what we have. Even though other public blockchains may have better languages. Same thing on the permission blockchain side. I'm not telling you to go learn, like Simple, which is the simple programming language, or like Dano, digital asset modeling language. No, go with something simple. Go build networks on Fabric, free open source project. And I believe Fabric uses Java. So if you know Java, just learn how to build a blockchain using Fabric. It's a fantastic framework for learning. It's kind of like Lego blocks. Once you're ready to use actual cement blocks, then yes, you're going to need a more blockchain focused permission blockchain. But Fabric is a fantastic framework to learn that ecosystem. Just like Solidity is a great way of understanding public blockchains in general. And also, even, as much as people like criticize Solidity and everything, whether you like it or not, Ethereum is the largest ecosystem right now for smart contracts. And that's the language that it uses. There's a lot of other things you can put on top, but that's going to get you the basics. But again, you don't need to be developing smart contracts to truly understand these technologies. You can also understand it simply from the conceptual level and just the architecture. Like there's some courses that I've been giving for a little over a year now that focus on taxonomy and evolution of blockchains. So I came up with a framework in which I organize all the different blockchains and I explain how they have evolved as a way of giving the audience a way of understanding how the different technologies relate to each other and what are the trade-offs. So at the very high level, you have 4 categories. Number 1, traditional blockchains. Number 2, the ones with the delegated proof of stake, which essentially centralize some of the block production. Then you have the ones that implemented privacy on a permission environment, like Symbiont. And then you have the DLTs, which are the ones that are more blockchain inspired. So as we have Fabric and Corda and all those that are not a true blockchain because they don't have that global ledger. So they break the concept of what is a replicated state machine, which is what you have in pretty much in the true blockchains. And then the true blockchains within the public bucket, you can then split that into the ones that have smart contracts and the ones that don't. So the ones with smart contracts, Ethereum. Without, Bitcoin. The ones that have token transfer privacy, Monero. So that kind of stuff. So now with that, you already have 6 basic buckets. And then within delegated proof of stake, you can break that out into a lot of other stuff. So once you have those type of frameworks, it really helps you see where things fit. Because every 3 months, we're going to get a new release. Oh, there's this new coin that is the next Ethereum killer. The latest one on this is Solana. Now, Solana is the next Ethereum killer. EOS was the Ethereum killer 2 or 3 years ago. Then Tezos. Cardano has been an Ethereum killer in the past, and now it came back again as an Ethereum killer. So even Hedera, Hashgraph, all these random projects keep coming up. So the flavor of the month right now is Solana. But until you don't understand how it fits together, how do you even know that is actually feasible? Can it be? And also, as I mentioned before, in this case, in this industry, a lot of companies fake it till they make it. They may have an amazing white paper and a really good roadmap, but they haven't built anything. So it should work in theory, but then, as we have learned at Symbiont through the 7 years of developing the platform, a lot of nuances in the details. That's actually where you realize, okay, there's a lot of things that need to be done. So our platform is super mature because of 7 years of sweat, blood, and tears put into it. The original white paper was beautiful, but what came out of the platform is actually not the level of detail is just exponentially higher once you look at what the platform looks like right now.
So I guess you're kind of saying it's about execution as well as having a good plan.
Yeah, exactly. You need to understand that you could have a great idea for a new blockchain, but until you don't actually try to code it and see how it performs and and all this. Like you don't know if it's gonna work. So like just going off of a white paper is, I mean, it's not enough. You may not even have, you may have a great white paper that in the hands of, you know, like the Adam Carlsteins of this world would be easy to implement. But then if you have a team that happens to be like the guys that you know from school that just learn Solidity, then probably not. So
Yeah.
like you have the idea, you have the team, that there's a lot of factors that come into it, and then there's the timing. If you happen to launch at the same time that some other like so-called Ethereum killers launch, and then people may not like you. But if you launch 6 months later when they forgot about that Ethereum killer, then maybe now you're the next blockchain.
No, actually, I was kind of involved in something similar. We were trying to build like a different NFT marketplace, and it was the same kind of thing. Everybody was just learning Solidity, and nobody really had the technical like chops to put it together, and the project ended up just falling through. But it was a good learning experience, I guess. But I don't know.
Yeah, exactly. I mean, like you're gonna learn a lot by doing. Like one of the best things is in this industry, as I mentioned, like network, learn, and the best way of learning is actually doing. So network, learn, and do. Those are the best things you can do in this industry if you want to get involved and also start learning and understanding a lot. I've met people in the industry that are super deep in the details of public blockchains, and then they have no idea about how permission blockchains work. And sometimes kind of like the level of understanding they have is what in Costa Rica you would refer to as daring ignorance. It's like they're so deep into it that they are completely blindsided by what another branch of blockchain can do.
Could you maybe like go to the difference between like the public versus like the private blockchain?
Yeah, the very basic difference between both of them, in public blockchains, you actually have a lot of unknown actors. In permission blockchains, they all know each other. So you don't need to, the main difference there is that if you have a bunch of unknown actors, you need to incentivize them so they process the transactions on the network. In the permission one, they don't, because they already know each other. So that means that in the public ones, you need to have some type of mechanism so that they talk to each other and act in a rush, well, in a best interest selfish way. That's where all the Nakamoto consensus come in, like proof of work or proof of stake, and then the derivatives from that, which is the delegated proof of stake consensus. When you have known actors, then you simply use classical consensus. Classical consensus, crash fault tolerance, Byzantine fault tolerance, which are at a base level 100 times faster than the public ones, because you don't need to go through like the song and dance to coordinate between unknown actors. You get past all that, so they're much faster. So depending on the application, if you want to do something that is going to process a ton of transactions and get close to the performance of the Visa network, then most likely you're going to need a permission blockchain. A lot of the networks that you see in public networks that claim, 50,000, 100,000 transactions per second, they're using sharding. So they're actually having a lot of parallel chains. That is not the same. And actually, a lot of those, when you look under the hood, what the consensus is, they're actually using classical consensus in a broader scheme of proof of stake consensus. So that's why like the details are important, because then you can understand. But again, high level, public and permission. The public ones need Nakamoto consensus, which means you need a token to incentivize people. Classical ones, you don't need a token. So at the very basic distinction, public chains are going to have a coin, an underlying coin to manage the incentive. You need miners and block producers. While on permission ones, you don't need that. You could still have tokens that are created both in the public one, a token that has nothing to do with the underlying consensus. Just like in permission ones, you can have some type of token or token representation that has nothing to do with a consensus. And then, by the way, an important things there, because in the public ones, you're incentivizing miners and it's a bunch of strangers, their capacity to store data is very limited because you got to pay for every block. Why is it so expensive to store stuff in Ethereum? It's not because the hard disk space is expensive. I mean, we'll have laptops that have at least, well, like half a terabyte, if not a terabyte of storage. The whole Ethereum ledger right now, I think it's like 3 gigabytes or something. That's not much. That is cheap. You can go to Best Buy and buy that hard drive for literally like for $300. You can probably get something like several terabytes. So it's not a big deal. The expensive part is that you actually, by putting all the data on the chain, you're taking away from other transactions So you need to pay for all that space that you're putting in. Like in Bitcoin, for example, the block size is like 2 megs. So what if you want to store a picture that is 10 megabytes? You're literally paying for 5 Bitcoin blocks to store that picture. And I don't even know if you can actually store it. Maybe you could do something where you put it in the memo field and then separately with middleware, you grab that and reconstruct it. So assuming that it was even possible, you would be paying for 5 blocks. I mean, right now, I don't know how much every block of Bitcoin is, but I think recently I had looked at what every block of Ethereum was. And I think if you wanted to buy a whole block for yourself, I think Ethereum was something around 70 grand. So Bitcoin is likely probably higher. So just, it doesn't pay to store stuff in public blockchains. And also, I mean, there's the whole point of security, like everybody's gonna see it. And then if you encrypt it, it's in the public domain. So 20 years from now, when you have quantum computers, somebody could go and they may have been storing all of that, and then they can go and decrypt it. Well, in a permission network, you're only within a certain group of companies that are bound by legal agreements. And even if 20 years from now they can decrypt it, they probably have some type of restriction or something to erase all records or something or whatever. At least it's not in the open where you know that Russia is storing everything to see what they can decode 20 years from now. Yeah. It's limited exposure. So public blockchains are in generally slower, and they have lower storage capacity, and they have no privacy. Public blockchains are really good, however, to reach a ton of people and have a lot of nodes and a lot of users.
Yeah, I mean, I don't know what else is there. I guess one other thing that I kind of wanted to ask you, it's kind of unrelated to the past conversation, but what do you personally do in your day-to-day with your job? Are you involved in the like technical, like developing smart contracts or the actual like coding, or are you more high level?
So on my day-to-day, because I'm doing business development, is more like reaching out to potential new clients and prospects. I do a lot of like looking at what would be good potential use cases and reach out to relevant players in that. Once there's somebody interested, a lot of what I do is explaining our technology and how it differentiates from other ones, which is why this led me down the path of eventually creating my own kind of like blockchain taxonomy framework. It came as a result of just talking to a lot of clients, and I was like, hey, this could be helpful outside of the Symbiont context, so other people understand the difference between public and permission, the difference between the different permission implementations, the difference between different consensus algorithms, and all these things. So there's a lot of explaining. Once there's an actual project, there's a lot of brainstorming with the clients on how can this be done. Client can say, okay, I want to do this, and then okay, my first question is like, tell me who are the actors, what is the data that you're sharing, what is the logic that you're sharing, and who has access to what. So you're looking at the actors, how they interact with each other, and what is that privacy model. At a base level, then that helps me to understand, okay, this is the nodes that we're going to need. The identities, i.e. the users, are going to live in X number of nodes, and this is how they're going to exchange information with each other in a private way. So once you have that model, then you can then move forward to other stuff. Like then once the client's more engaged, then you're gonna have to onboard them to the software development kit. So I'm gonna explain them how our language works. Why is it that simple on the front end looks and feels like Python, and then on the back end is more like Haskell? So it's kind of like ease of use on the front end, but on the back end, the robustness of a strongly typed language that is very good for distributed paradigms.
Yeah, so simple. That's your company's own language. That's proprietary to you.
Yes, it's called Simple, SYMPL. It stands for Symbiont Programming Language.
And were you involved in the development of that? Or?
No, we had PhDs in a programming language theory that take care of that. Okay. I'm the guy that after they did all the hard work, I go and I tell them, now explain it in simple terms.
Okay.
So, I mean, I did computer science in undergrad, computer engineering. So I did a lot of coding. But when you're designing a language from scratch, it's a whole other level of detail. Like the abstraction, all that, it loses me. It's a little too much.
Yeah. So and is Simple, is it like available for public use, or is it private to your company?
So it's we make it available to prospects and clients, and also now to some consulting firms that want to use our language for experimenting. At some point, the idea is to make it widely available. So I think we're aiming for sometime next year, maybe hold a hackathon where we make it available to like a large group of developers for the first time. There's a lot of challenges with that, mainly the support model. If we only make it available to a few clients and some consultants, then it's easy because then you just like handle those specific support tickets directly. If suddenly you make it available to like 1,000 developers and you're getting like 200 like support requests every day, now you're going to be fielding a lot of using a lot of internal resources to field all those requests, and unless that is literally generating projects that generate revenue in the future, it may not be the best use of our time. But at some point, once we reach a certain level of adoption, it would make sense to actually hire people to be dedicated to managing communities and answering this. For now, it's not the focus because we have our hands full with the large financial clients that we have. So as of now, is not our interest to develop that, but we know that it will become, and it'll be very important to start developing that. So we're starting first by establishing relationships with IT consulting firms that are super excited to learn our language so they can then go and offer Symbiont, which before, if anybody wanted Symbiont, they could only come directly to us.
All right. So I guess so before we let you go, I guess you can finish with a closing question. So a lot of people compare blockchain to like the internet. They'll say things like blockchain is the internet of money. This is like the next internet. What's your opinion on that statement? Do you think it's accurate?
It's accurate in the sense that it's a new technology that's going to unleash a whole other world of innovation that right now we don't even know what it is. If you think about the fact that right now you can order food via your phone to arrive at your house via Uber Eats, this is mind-blowing. If you think about all the technology that needed for that, you needed the internet, you needed like cell phones, you needed cell phones with actually like good like data connectivity. You needed to be able to have GPSs that then you connect to an app that allowed to trace a car, and then that you need some interface that then connects the restaurant and the car, and like there's all these things that when you order Seamless or Grubhub, you don't realize how much technology went into that in the past 20 years, from like the internet and the cell phones and the apps on the phones and the GPS and all that, to do something that is simply, I just want a pizza because I'm tired and I don't want to cook. So the same thing is going to be with blockchain. We have no idea what's going to happen. I mean, when I entered this industry 5 years ago, ICOs were barely starting. And then there was the whole fight about, okay, what's a utility token? What's a security token? Now look at all the innovation within securities on chain. It's enormous what has happened. Same thing now, like the tokens have been used like for a lot of other things. Stable coins are finally starting to expand, and I mean, they have a lot of issues, but they're starting to like do something. There's a concept of CBDCs, the central bank digital currencies. NFTs are now starting to do a lot of stuff. In some cases misguided, in some other cases it makes sense. I mean misguided because I hate when somebody uses an NFT to cloak security. So there's a lot of stuff that we didn't think about before. DeFi, yeah, DeFi was possible, as I mentioned, back in 2012 when our co-founder created Counterparty, but it just didn't take off then. And now it did, and now it's just growing exponentially. And even if regulators are against it, it's going to keep growing at the retail level. So we don't know where all this innovation is going to go. So that is why I think like it's a good analogy in terms of how internet spurred a lot of innovation. Blockchain is going to spur a lot of innovation, but we don't know what that is. What is a terrible analogy that I hear all the time is, oh, like the internet and the intranets are like the public chains and the permission chains. That is wrong on many levels. That is implying that permission blockchains are essentially going to die like the intranets. That is wrong because the intranets never died. The intranet still exists. Every company has their own intranet. So whoever thinks the intranets are dead doesn't know how companies work. Intranets still exist.
What's the distinction between, is it intranets?
Oh, an intranet is simply when you have a company, and I mean, even at the university, like you're gonna have a network that is only within the university. It's not external. So it's only like only people, and like it's a network that is only connected to all the different servers in the university. It's not open to the public.
And like the
internet is a connection of public servers that somebody stand up. So when you go and you type google.com, it goes to a server sitting in a Google campus so you can do stuff. or if you go to like your university's webpage that is actually being served from some server, maybe from the university, maybe hosted on Amazon or something, that is what it is. So it's a collection of public servers. But within a given organization, you could have a lot of servers that are internal only to the organization that you cannot reach from the outside. So intranets still exist. It's the number one flaw. And then second flaw, permission blockchains, as I mentioned earlier, is blockchain itself is the technology. Permission blockchain is not, a lot of people think that the end game is public blockchains, and in the end, everything should be public blockchains. I think that I have a completely opposite view of that. The end game is blockchain itself as a technology, not public blockchains. Public blockchains is a very small application within blockchain that allows the transfers peer-to-peer of tokens. Very limited when you compare against all the other stuff that permission blockchains can do. So yes, there's a lot of things that are increasingly available to be done in public blockchains, but similarly in permission blockchains, there's a lot of more things that you can do that will never, well, I would never say never, but that are very hard right now to do in public blockchains. So it's not okay to compare internet and intranet to public and permission. I think that actually just shows that somebody doesn't really understand how this all works, how it all started and where it's going. In the future, people shouldn't be talking about blockchain. It's just gonna be. So like, for example, like 5 years from now, Symbiont, where's Symbiont gonna be 5 years from now? Well, I think we're gonna be powering a lot of large financial applications between banks and asset managers, etc. But 10 years from now, why would people be talking about Symbiont? It's gonna be running all that stuff in the background, but like, are people talking right now about like, hey, I love your Oracle database, that is the coolest thing? Like, no, it doesn't matter, it's there, it's running in the background. Same thing, like in the future, like if we're gonna be doing banking on public blockchains with DeFi protocols that are super advanced that we haven't even thought about today, nobody's gonna be thinking, oh, like, does your wallet run on Ethereum or does it run on Cardano? It doesn't matter. It's an app on your phone and something else is running. That's it. You don't even know because your WhatsApp from the future or your Facebook Messenger from the future simply says, I want to send money to call, send. That's it. You don't know how it happened. It may have happened via blockchain, may have happened via a centralized server at Facebook, or may have happened through like some future technology. It doesn't matter. People shouldn't be talking about this. It'll be like nowadays talking about, like, hey, have you seen the latest TCP/IP protocol? No one cares and no one should care. Once it's part of the system, you should be talking about the integrations on top of that, like many layers of on top, which is what the user sees. Nobody's going to be talking at the network protocol layer.
Yeah, that is really interesting. Just that, like, a lot of the things that we take for granted today, just like all the complexity that went behind them and all the people that worked on it, and how even like the things we've used like cutting edge technology today are just gonna like in the background in 20 years. So it's a really interesting thought.
I mean, even like taking the DeFi ecosystem. I mean, how did it get to where it is today? Well, first you needed somebody to create a network that had smart contracts, which was, an innovation from what Ethereum was. Sorry, what Bitcoin was. Then you needed smart contracts with like, specific functionality. So like Solidity may have evolved to like have other stuff. Then you needed multi-sig signatures. Then you needed zero knowledge proofs don't necessarily apply in all DeFi protocols, but I'm sure it's baked in somewhere there. Then you need to be able to have escrow. I mean, that's also going back to the signature. So there's a lot of small components that you put together, and then you realize that, okay, like we just created something where I just lock some tokens and it automatically is gonna give me some yield farming across like 3 different protocols, and I'm like, I don't know, cross-chain swapping to like Binance Smart Chain or something. But in the end, you don't care because you're at the top level, just using like something that depends on 3 layers below. And then same thing, even within the permission blockchain arena, how did we get to where we are? Well, like Byzantine fault tolerance was actually around, classical consensus was around even before blockchains were around, because it's computer science, it's computer science concepts that actually date back to like, I think even like 70s. I think that type of consensus predates computers. The Byzantine generals problem, it's actually not even about computers. It's about generals like talking to each other. So it's like, these are things that they may even have their basis like in philosophy. They go way back. So anyways, you have that on the consensus. Then you have like the different ways that nodes operate. How do you operate nodes on the cloud? Well, you have microservices architecture. So for that, you needed first for companies like Amazon Web Services and Microsoft Azure and Oracle Cloud and what am I leaving out? Like Google Kubernetes type of technologies to exist. So all these microservices could run together on the cloud to operate what we see as one node. But that node is a collection of microservices. There's a lot of new cryptographic techniques that have evolved that allow these things to happen, or at least to happen much faster. So there's several things that have evolved to bring us to where we are right now. And of course, I didn't even mention all the innovation in terms of the languages and all that. So it's like, which is much more.
All right, I think we covered a lot. So
All right.
Cool.
I guess that's
all right,
it.
guys. Well,
Appreciate
you know where to find me. So if there's any follow-ups, happy to chat. Also, if you're gonna put this in a podcast, like if people need to reach me, the easiest thing is like either via Telegram, which is my last name, so Truque, or find me on LinkedIn. But if you add me on LinkedIn, put a message of why you're contacting me, because if not, I get too many requests and I don't know what people want. So I'll probably reject.
Can you say that again? What were we saying?
That if people reach out to me via LinkedIn, make sure you add a note on what is your interest. Even if it's hey, I just want to follow what you post or something, because if not, I get too many random requests that are just seem like spam. So.
Well, appreciate it. Thank you so much for talking to us. We learned a lot. Stay in touch.
Cool. Awesome. All right, guys. Best of luck. Take care. Bye-bye.